Hey guys, welcome back to the channel. Today it's kind of a special video. I was going to add this to my weekly options update video, but I didn't want it to be 30 minutes long. I actually have a couple of things I want to go over, so I'm actually making 3 videos this week. I think I'm going to release them all this week. That's going to be this rolling video, my weekly review, and then I'm going to do a special one showing you what I look for when I put on or when I sell cash secured puts, naked puts, etc. And you'll be quite amazed at how simple that I make it. I'm not saying I'm the best or anything, but I don't do anything very fancy when I put on my trades. And so look forward to that. I don't know if it's going to be before this one, after this one. You'll figure it out when it comes out. But today what I'm going to talk about is actually rolling a position and rolling for a credit, rolling to get safer, and rolling to get much safer than what you would normally do, right? So I got you in here in my Interactive Brokers Trader Workstation platform here, and you'll see for today, I'm doing this today, Friday, August 6th, because it's fresh in my mind, and I still have the option chain available that expires today. So you'll see right here I got a negative 166.40. So I took a loss on a trade, and it was a cash secured put or naked put on the XOP ETF, which is the Spider Exploration Oil Exploration Oral Oil Exploration ETF. What I had was a August 6th, which was today, 85 strike put. Well, as you can see by the numbers here, were $82.25, so it would have been assigned to me at $85 if I didn't go ahead and take the loss or roll it. But rolling, a lot of you guys know I don't like the term rolling because it takes into account that this contract that I sold is somehow connected to the next ones that I put on, and it's really not. This one's done. I took a loss on it. This contract no longer exists. So I took a loss of $166.40. I bought it back for $3.20, and you'll see right now I could have actually got out of it a little bit cheaper if I would have waited later on the day, but I went to the dentist today and I didn't know if I was going to get back in time to close it before the market closed, so I did it in the morning. So what does that tell you? That means that I lost money, and I'm going to show you what you could do is when you roll a position. A lot of people will roll the position until the next week and hopefully get under the strike price, right? So if we're at if we had an $85 put and it's at 82.25, let's see, if we go out another week, we'll look at the 85. I could have rolled to next week at the same strike at for roughly $3.35, which would have covered what I closed out the expired put for. But that still leaves me in the money. Okay, so what do? We keep going. We go to 2 weeks out, and now I could have went to the 84 strike, okay, and it would have covered that 320, but still in the money. Okay, so let's go to August 27th. Where can I go now? Now I can get to the 83 strike, but still again in the money. So we have to go all the way to September 3rd to actually get just in the money at $82 strike, and you could have got $350 for it roughly. So what did I do? I didn't do either one of those, because when I roll, I like to make more money, right? I don't want to just cover what I did. If I'm going out in time, I think I need to make more money. Otherwise, it's just lost time, if that makes sense. So what I did is I went out to September 17th and I sold the 75s, and I got I'll show you, but I got $2 and something for each of those. So I went to the 75 and I sold 2 of the 75s. Okay, now those 2 covered the cost of the what I closed and some. So not only did I push it out another month, I got a lot safer on the strike, and I'm making more money than if I were to just roll it, week by week in the money. So got safer, got more money. The con is you just doubled your exposure. So now instead of 1 contract, I got 2. So that's the big con of it. But the pros of doing it this way, is getting safer mostly, and then making more money. Because if you looked at it, even if you rolled to the one that was in the money or just barely out of the money at the 82 strike, you're selling a 46 delta, right? So you're really, 46 delta, that's like 50-50 chance of you making it, making a profitable trade there. But the way I did it, I went out to September 17th at 75, and we got down to the 24 delta. So increased your chances by 50% basically over the other one, and made more money. So we'll look at it in a spreadsheet here, and we'll just see that in action or in real numbers here. So I just have the standard spreadsheet. I'm just doing this for calculations, but as you can see, June 28th, I sold that 1 contract. Price of the stock at that point was $97. I sold an 85 strike, collected $1.55. Exited that today for $3.20, and so the total profit was negative $166.37. Now theoretically, I only had to cover this $166.37 loss, but I'm not in this to just make money, right? Because that I consider I wanted to make money, so I want to cover this whole price, right? I want to get back the premium that I lost essentially by buying this back at a higher price. So today you'll see that September 17th, the price of the stock was $81.80, got down to a 75 strike, collected $205 on each contract, sold 2 contracts. So we brought in today $409.33. So net max profit on the entire thing is $242.96. So not only did we get safer, we're making more money, because on this one, the max profit you could have got was that $1, basically $155, right? So to be able to get much safer on the strike and collect more money, I think is a win-win. It probably won't work on every stock. Yeah, it probably would work on every stock. It just really depends on how far it's fallen. But as you can see, the max profit was $155 previously, and now the max profit is $242.96. So, rolled it. I don't like that term roll. Doggone it. Bought it back for a loss and sold 2 at a lower strike to cover that loss. And now my max profit is $242.96. So I gained about, what is that, $90, $87 extra by going safer on the strike and adding a contract. So that's it. That's how I handle some trades that go in the money. I could have took the stock at 85 and sold a covered call. It probably would have been worth it today because XOP was up. Let's see, if I would have took it and sold a 1 week out, I would have made $55. Yeah, I just did not want to take $8,500 worth of XOP. So that's the way I roll. That's the way I roll. That's the way I handle. That's one way to handle trades or puts that are, in the money that you want to avoid assignment on. Another way to do it is just take the loss and move on. There's no nothing to say that you have to play XOP if you took that loss, right? You can make up that loss somewhere else on another trade. So in order to do this and make this successful, you really have to still have a bullish position or a bullish thesis on your position, because if it was, if I went down to the 75 strike and I thought that XOP was not going to stay above that, then it's kind of a moot point to do that, right? You could just go find a better trade somewhere else. So that's all I got. I hope it was helpful. Me rolling an XOP contract from one contract into two and getting much safer on the strike. Hope you guys enjoyed. If you got any questions, comments, concerns, leave them down below. Like, share, subscribe, do all that good stuff. And we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.